All right, we're going to get rolling.
They helped create an economy that was completely addicted to cheap money.
You need to buy savings bonds or something. You need to be way, way, way out of this space.
I subscribe to Miss Piggy's rule of money management. Always manage to have more money, you know what I mean?
It wasn't but 2 years ago that everybody was saying China's economy was going to be bigger than that of the United States. It's gone in the exact opposite direction.
So we're going to jump right in.
Welcome to This Week in Mining, where we talk about making money in the metals and the mining market. I'm joined today by Chris Vermeulen. Chris, it's great to see you and great to have you back on the show, man.
Hey, thanks, Jay. Always a pleasure.
Okay, so when it comes to investing, I find like one of the hardest parts, Chris, is knowing what questions to ask. Are we asking the right questions to get the information that's actually helpful to our portfolios? And one of the most common questions, although maybe not the right question, that's being asked in finance today is what is the probability of a rate cut in the upcoming cycle? And how much will that impact everything? So what's your take on that question? Is that the right question to be asking?
Yeah, so I mean, I'm a technical trader, which means I like to follow price. As an investor, all of us, we all want the price of our asset to go up. So I focus on following price. When it comes to news and interest rates, everybody's talking about them. Everybody's like waiting for the Fed to cut. They're predicting the Fed is going to cut. They're doing all kinds of stuff. To me, all of that really has no saying in anything because typically price leads things. Like, for example, I think rates have probably topped out. I do think we're going to start to see some cuts. I don't think it's going to happen right away. I really don't see enough blood on Wall Street yet itself from in terms of an equity standpoint. But if we take a look at what rates are doing and how they've stalled out, and you look at what bonds are doing, like TLT, they've formed a very strong bottoming pattern. From a technical standpoint, TLT looks like it is forming a bottom. And really, it actually just started a new uptrend really in the last couple of trading sessions for the first time in years. So this is pretty exciting. And so bonds are already turning and are now in an uptrend. And so that tells us, or it should be telling us, that the rates will be getting cut, or they're really not going to go a whole lot higher, if at all. So I like to just follow price. And if you look at what the assets are doing and where the money is flowing in the equities markets, it's really going to kind of tell you what's going to happen, I think, with rates going forward. So price usually leads, and then we usually see the data come out afterwards. So I don't take any of it into account because it's always random. You don't know what the Fed is going to do. And even if you do guess that he does cut, the rate gets cut, you have no idea how the algos are going to react, how the mindset of people. So, the same rate cut next time will have a completely opposite effect on the market, from the reaction. So news is very random. To me, it's not something you can really trade. If you nail it and call it, I mean, it's really just a fluke. So I just like to follow price. And the markets typically tell us kind of what is going to happen. And the news is just noise.
So what are the markets telling you right now? What are you seeing in terms of capital flows, Chris, that you can share with me today?
Yeah, there's a lot of really interesting things going on. So, there's two major cycles at play. There's the stock market cycle, like the overall bull market cycle we've been in forever. There's the economic cycle. Typically near the end of a bull market in equities, we tend to see gold do very well. We tend to see energy stocks, and usually oil tops out actually quite a bit before the stock market does. But energy stocks are trading up near all-time highs. And we see industrial stocks do very good. They're trading up at all-time highs. And they're kind of three different assets. But industrials, for example, everyone just had a massive COVID bubble and businesses had been booming for the last few years. Things are starting to slow down, I think, but all these companies have piled in. They've upgraded their warehouses, their equipment, their assembly lines. Everybody thinks they've got a booming business. And usually the masses are wrong during major peaks. And so all these people have been upgrading their facilities, and all the industrial companies have got stellar earnings. And so the industrial companies are doing well. And most business owners don't realize there's a cycle at play here. They're literally upgrading at the most expensive time to do their equipment and right at the end of a growth cycle. So I believe we're going to go into a bit of a recession. I think things could get pretty darn ugly for businesses and real estate and the stock market. So the fact that we have gold and energy stocks and industrials all doing well is definitely a sign that we're in the late stages. If you go back to 2008, all three of these did very well. They kept going sideways or higher while the stock market actually started selling off about 8 or 10%. So That's where I think we're at. This final leg up in precious metals and industrials and energy stocks, I think they're going to hold their ground. And I think we're getting very close to a pretty big market correction. But I mean, right now the trend is still up. You got to be long the markets if you're an investor. And we've had some fear recently with the big sell-off and the big the Magnificent Seven stocks. But that's just one bout of selling. We need to see if that is going to happen again, or if that was just a big kind of trimming of profits from a lot of individuals.
So when it comes to the stock market cycle, the trend is still up. As you said, you still got to be long the markets, but you're seeing a handful of indicators, mainly gold, industrials, energy, all doing well, which often signify the end of that stock market cycle. And you use 2008 as the most recent example of this playing out. I'd love you to expand on why gold, energy, and industrials all performing well indicates the end of a stock market cycle, Chris. And then secondly, if I could, you say the trend is still up. I'd love to understand your time horizon. When you say you got to be long the equities market, talk to me about duration and time horizon.
Yeah, good questions. There's a bunch here. So you should be able to see my screen.
Yeah, I got it.
So here we can see the different cycles at play. This blue cycle is the stock market cycle. The yellow one in the background is the economic cycle. Generally, we see the precious metals, energy, industrial capital goods perform very well and outperform, which they are. That is usually heading into a major market top. And if we were to look at the SP 500, or sorry, not the SP 500, the chart of gold, and look at it from a monthly standpoint, we can see a very similar pattern that happened back in 2008. So, or even early 2000s, we started a new super cycle in gold, in commodities in general. I believe we've started a new super cycle in commodities in 2019. And then, of course, we saw a multi-year pause in precious metals going into like 2007. And then out of that, as we got closer to a stock market top, an economic top, people started moving into gold as that global safe haven play. People want to move to a store of value that is less volatile than the stock market, is physical, all that stuff. And so we saw this huge move up. Well, we've had the same thing. We're in a new super cycle. We've just had a multi-year consolidation, and now everybody is running into gold as that global safe haven play. And I believe we're going to have a stock market correction probably starting this year some point. And we're probably going to see commodities get hit and pull back a little bit, just like we did in 2008. And then after that to me, I believe next year will probably be like the ultimate buying opportunity for anyone in the commodity space, precious metals, miners, uranium stocks. I believe it'll be like the next kind of reset, just like after 2008, where we're going to have a multi-year run. They're going to go absolutely ballistic. So that's kind of the scenario of what I see with gold and the sentiment. And people are moving into this. I think we still have more upside, about 2,750 on gold. I think silver can hit about $24, $26 an ounce before I think maybe we hit kind of the stock market top and recession and things kick in.
And is this a consequence, Chris, of a larger population of people looking at the broad equities market and saying, this is making less and less sense? And eventually, when the last buyer has bought, all that will be left are sellers, and I don't want to be caught in that trap. And so they're beginning to de-risk, not knowing when the market will correct, but assuming we're getting closer to that point and it's time to put some chips on the lifeboat. Is that accurate, or what's your take?
Yeah, I think that's pretty accurate. I mean, the precious metal space is very, very tiny in the grand scheme of things. So It doesn't take the whole world to drive it up. It just takes a whole bunch of us nervous to start accumulating it. I believe like where we are now, where we've got a stock market bubble, a tech bubble. I mean, you could argue it's a tech bubble. AI is huge. It hasn't even started yet. I wouldn't say it's overvalued, but it might be a little bit overbought short term. But we've got a real estate bubble. We have all the same type of things that happened, back in 2007, 2008, where everything was overpriced. I actually believe this is a lot more like a kind of like the tech bubble. Not because the Magnificent Seven have taken off. The tech bubble back then was different. It was a bunch of companies that were worthless, really, had no income. The tech companies now are like powerful, highly profitable. But I believe we're going to go into like a multi-year consolidation. The market always does what we least expect. So I think we could see weakness in the stock market for a long time. I think be like the rise of the commodities. I think there will be some pockets of stocks that do really well. I think there's a big shift towards climate and clean energy, and uranium is actually a big part of that. As much as a lot of people think uranium is really bad. I think we're going to see a big shift into commodities and precious metals. We're going to see currency problems. So I think the stock market it's had a beautiful run, but I have a feeling it might do what people don't expect, which is be dormant for 3, 4, or 5 years. After the tech bubble, we saw about a 3-year bear market. That's a painful time. Of course, in technology, it took 16 years to come back. It took 12 years for the SP 500 to come back. And the market could very easily do that. And I know you're a big believer of, moving to where an asset, don't get married to an asset. Don't fall in love with just one thing. Move to where the money is going, which is my whole philosophy. I call it asset reinvesting. We reinvest our asset into whatever asset is showing strength and moving up. I love a lot of different things, and I don't own any of them because they're not favorable or they're not moving up. But I will get back to them when that time comes. So that's kind of the big key of what I really focus on. I think similar to you is let's move into things we believe in, that we understand, and that are moving higher.
Okay. And I appreciate that. And similar question on the energy front, if you could expand a little bit on why, when you see, I guess the relationship between the gold, the energy, and the industrials, and why all rising simultaneously. Is it a similar methodology for energy stocks that you see, Chris?
It's fairly similar. I mean, we saw energy have a huge run up just for the 2008. Just looking at this chart, it's more or less at a pretty major resistance area. Obviously, we have wars going on, all kinds of things. I think energy has a potential, depending what unfolds overseas. There could still be another big push up in energy here. But the fact that they're all frothy and highly valued just generally tells us that we've got all kinds of chaos going on. And energy stocks are usually kind of people move into them expecting chaos. They're expecting bigger wars, all kinds of bad things. And of course, when things fall apart, it becomes fuel, guns, food, precious metals. I mean, things become very valuable very quickly. And so usually during really frustrating and difficult economic times, when people get nervous, energy stuff becomes very powerful or highly valued. So it's just up at a resistance level. And if we take a look at industrials, it's kind of a different scenario. This is more so just the mindset of business owners not realizing we're at some type of major cycle high. But industrials are performing exceptionally well. They just keep pushing to new all-time highs, and everybody's been upgrading and buying, and factory warehouse workers, they don't know the bigger pictures and cycles at play. And maybe they're right. Maybe the market wants to go higher. Maybe it will. But overall, everything is lining up. Like when we go back and look at this yellow chart in the background, which is the economic cycle, we're already seeing unemployment rate starting to creep up. It's already crossed the 200-day moving average, which every time it's done this, we've fallen into some type of recession going way back like 50, 60 years. We've had some type of big market correction. Unemployment is going up. We're seeing government jobs openings are skyrocketing. It's almost like the government's trying to create jobs and trying to just get people working. All kinds of things. We're seeing people have run out of money. I mean, there's a couple of really interesting charts here of this one here shows government's jobs as a percentage of overall jobs. Every time we see the government start to create a whole bunch of jobs, we go into some type of fairly big recession. The other thing is we've just crossed over into unemployment, full-time people finally getting laid off, right? I mean, for a while you couldn't hire anybody. Nobody wanted to work. They all wanted to work from home. And all the contract workers have been starting to see hours get cut. And now we're actually seeing full-time employees being like, hey, business is actually slowing. A lot of businesses are struggling a lot. And so people are starting to lose their jobs. And, we crossed over the point from COVID where we had tons in America. There was excess savings in accounts. Now we're minus. So people have burnt through their savings. Inflation is making everything expensive. So the tide is changing. And I always like to look at the stock market like a rising or falling tide, which was one of your questions. And the best way to view this is really just looking at the weekly chart of the SP 500. And a good way to look at this is really I'll just zoom into the more recent price action this is right after COVID. The key here is to identify when the market is trending up through price action, through money flows, through sentiment, through where money is flowing to different various assets. Are they moving to risk on, or are they moving to risk off assets? We want to know when the tide is going up. That's when you want to be an investor and you want to hold stocks. When that shifts, you do not want to be holding stocks. You want to move somewhere else. You might want to move to gold. You might want to move to bonds or the US dollar index. 2022 was the stock market pulled back about 25%. The US dollar ETF rallied about 18%, which we were long. So you just have to move. You just step to a different asset that benefits from weakness in the equities markets. And we've been in a long investor signal for a while. And the market, well, the market internals right now, Jay, are breaking down. Behind the scenes, this scenario we have is exactly the same as this scenario over here. So I believe we're very close to like going over the cliff and starting another bear market. And then the question is how big? Is it just a 2022 pullback, or is it an actual like financial reset of some sort? Who knows? But the scenario, we're in a very unique point here where by the end of this year, I think we're going to know for sure if we are in a major bear market correction or not. But that's the way I like to look at it. Is first of all, you need to know if the tide is going up, you want to own equities, just like the ocean. Rising tide lifts all boats. And then on top of that, I like to play shorter term moves in the market to take advantage of these swings as a bit more of an active investor. But understanding when we're in a bullish or bearish environment is a game changer. When you can step aside and move to cash or move into something that moves up in value while the stock market is figuring itself out, you can double or triple your annual returns just because you're moving out of something going down and you're holding value or earning daily or monthly interest, still growing your account, and then you hop back onto the market once it turns around. So that's like the high level view, is just understand the market and the stages. And I think you and I actually talked about the market stages the last time you and I spoke, which there's 4 stages to the stock market. And right now, the stock market is in this stage 3 topping phase. And without getting too much into details, the NASDAQ and SP 500 have been hitting all-time highs. So people will be like, well, it doesn't look like this. But the reality is the market blew off and it's in this complacency, this pause. And if we were to scratch out the large cap stocks, the weighting of them, we can look at RSP symbol and IWM, which is the small caps, and IWC, which are the micro caps. And if we just look at this price action, we are in what I consider a stage 3 topping phase. And this is where the market had a blow off move. And now we're in this complacency move. And I believe we're eventually going to go off a cliff and actually probably retest the COVID lows. That's just kind of a big picture view of where we're at. But this little pop that we've had, it happened in small cap stocks. It happened in small cap stocks right just before the 2022 bear market. It also happened just before the 2008 sell-off. So there's so many layers to this without getting into crazy details that everything is lining up that like we are about to have a pretty big reset, and people need to know how to protect their capital and move, to safety, because this could be very devastating for people near retirement or retired.
Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, U.S. Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video. So you mentioned we're in this scenario, and then you referenced 2008, similar scenario in terms of market activity. And I believe what you said is the market is breaking behind the scenes. And can you speak to any of the vulnerabilities and fracture points? I mean, we just saw a big one a month ago with the yen carry trade unwind. Do you see any other obvious vulnerabilities, Chris, or is the nature of market corrections that they're difficult to identify in advance of them occurring?
Yeah, I mean, it's super difficult. Obviously, as we have more other countries and other things break, those are always just like, shot across the bow that things are weak, not just, in Canada or United States, but everywhere. And so I think a lot of countries and financial systems are literally duct taped together. And it's just a matter of time before something starts to fall and all the tape starts ripping off, right? And everybody will go down like dominoes. That's the whole point of what I do is by following price, I don't have to try to, those are just warning signs to be like, hey, things are getting fragile and brittle. But the nice thing about it is you just have to let the markets move and then have a way to track a trend. Identify when a new trend is starting and know when it's coming to an end. Have all your different ways to gauge that. And so a lot of times, like on our charts, when I was showing the weekly chart of the SP 500, there's sections of red bars where we step out of the market. That's simply, even if the market kept going up, we still got out of it simply because it was saying, hey, listen, the money flows are going the wrong way. Money flows are going into different defensive assets. They're not going into stocks. All kinds of things are coming together and some cycles that are at play that could create this pullback to turn into a collapse. And so it's much better to step aside when the market is giving you all the reasons to step aside. Who cares if you buy back at a little bit higher? I'd much rather avoid a crash and be stuck in it for years than just say, okay, well, 4 months from now, I'm going to jump back into the market. I'm going to pay 8% more than where I sold it, but I'm going to be back into a strong, solid trend that I trust. And it should last for another, multiple years, hopefully, if it's a bull market phase. So you just have to step aside when things get brittle and wait for the dust to clear, which is where we're at right now in terms of shorter term kind of investing signals. And we just need to see if we have another leg up on the market or if it is going to roll over. And this summer or by the end of this year, we're going to probably have some pretty clear details of where we're at. So,
and you're going to wait for those indicators before allocating capital, which leads me to believe you're in some way sitting on the sidelines today, whether that's in cash or cash equivalents or other assets. Walk me through, Chris, if you could, where your portfolio, how your portfolio was allocated maybe for the last year and where it is today. And that'll give us a sense of how you, and then obviously you're waiting for signals this summer to determine where to go next.
Yeah, so there's a couple different, let me pull my chart up. I'll just kind of show you a visual here a bit. So there's a couple different ways. So first of all, I'm big into precious metals. I love physical metals. In fact, my buddy was moving countries and he didn't want to take this. So I bought his 1,000-ounce bar off him just for the hell of it, because he's like, I can't get rid of it. It's hard to sell 1,000 ounces. It's considered industrial. I bought one a while ago for my wife and I, and now we need to get one more. So my kids each have one. But I love physical metals and I hold them as a small percentage of my portfolio long-term. I don't care what they do. I just accumulate them. I believe commodities will keep going up. I believe there's tons of upside in them. So that's like a small chunk, 3.5%, 5% of my portfolio that just I leave it in physical metals.
You said 3.5%, 5%.
Yeah, of kind of my net wealth. Yeah.
Got it.
Yeah. So, and then when we go and take a look at the market, so there's a couple different ways to look at this. So if you're like long-term investing, technically we should still be long the market. This is a passive way of playing the bulls and bears. But what I do is I focus on a shorter term strategy, which I call CGS or active asset revesting. And so I have multiple trades. I'll have 3 to 12 trades throughout the year. I move in and out of the SP 500, bonds, US dollar index, or BIL, which is like a cash equivalent. You just earn a monthly dividend with no downside. It's just a store of capital. So overall, right now, we are sitting in a cash position waiting. So the market we got out a few weeks ago before the market crash. The technicals were saying, get out, something fishy is up. The market has had the super sharp pullback and crash, which we got to sidestep it and just collect daily interest. And now the market's trying to set up to figure out if they want to go into a new uptrend. And so right now we are sitting in cash, and potentially this week we might actually be getting long in the markets. We'll have to just see. There is potential that this market is going to roll over and sell off, and we'll continue to stay where we are, which is in BIL at the moment. But we'll be looking to get into bonds potentially if the market does sell off in a bigger way. And so that's kind of where we are. In a nutshell, because I don't do more of the more passive strategy. I just like to know on this upper chart here, is the tide going up or down? But the fact that they're breaking down behind the scenes, this smaller term chart shows a little that more at a granular level. And so I'm in a cash position. So, we are long the markets. We played beautiful moves from 2023 up. We got stepped aside for a little bit. We got back in. We've stepped aside. And so we really just identify these trends and we just play them in the market. So we don't really know what we're going to be in, a month from now. We just let the money and the charts decide. But we just rotate from stocks to bonds to currency to cash and kind of dance around the market that way.
With the gold price performing the way it's performed for the last 6 months to a year, Chris, have you been surprised at the lackluster performance of gold equities?
Not really, because when you look at gold's at all-time highs, and you look at the miners. The miners are nowhere near the highs from where they should be. They should be like blasting past that. But the miners definitely have some serious headwind. COVID, I think, played a lot of havoc on that sector. Not only like fuel is expensive, equipment, labor, everything. It's so expensive to get gold out of the ground now, and I think that's really kept them muted. But typically, when we get into this type of scenario that we're in right now, which is I think the stock market top, we generally see gold do the best. It's the most consistent. So, for example, if the stock market starts to roll over a little bit and starts to go sideways or down, the miners they're stuck in the stock market. They're part of that tide. So even though money will be flowing into it, that tide is still pulling down on it. And those little miners are trying to go up. So it's a struggle for them to perform really well. Whereas gold is disconnected from the stock market, and gold is more of a global asset. So every country and everyone wants to buy it, and it's slow moving and it's expensive. So they kind of buy it and hold it. So there's a natural accumulation going on. I love physical gold. It's what I've been screaming forever. I'm like, if you just want a low volatility, high probability trade, something like an investment that will just be consistent and not scare you and shake you out, gold is the one. And there's comfort in that. You might not get the biggest returns, but there's something about having, if you have a lot of money you want to protect, you don't want to throw it through a roller coaster. I like gold. So miners always struggle. In 2008, we saw gold perform really well and silver did all right. But miners struggled because they're stuck in that stock market that is going down. So the stock market's constantly pulling down on the equities. They should do fine. I believe we'll see like GDX go to 45 here. I think silver is going to go to 34, 36 in the next month or two. Gold 27.50. But then I think that's when things come to an end, because the long-term monthly chart of the super cycle targets 2,700 for gold. And so once gold hits 2,700, it's like it's game off. Like, who knows what's going to happen? That could be the time where stock market tops, gold tops for a while. But right now, if the play is just physical gold, GLD, whatever you want. I just like the gold play simply because the miners are struggling. They've come to life recently, but they are still a struggle. I believe miners will be absolutely amazing once we have this financial reset. I think next year, anybody who's played the miner space during the beginning of a super cycle, it's life changing, right? So I think that's coming next year, which will be like back into penny mining stocks. They'll all be revalued to some extent. So there's lots of opportunity coming. But I think physical gold is the low risk, high probability play right now to squeeze another 8% out and then call it a day, be happy, and then figure out what to do from there.
Right. Okay. So exposure to gold is heavy right now, expecting a run probably to somewhere around 2,700, but eventually you are expecting this market to roll over. And when that occurs, anything liquid gets called, including mining stocks. Usually gold hits the bid. People need cash to cover their positions, and so everything gets whacked, and the ebbing tide drops all ships. Coming out of that is called that, like, at some point 2025. That's when you would expect positioning in the minor equities to be pretty opportunistic, correct?
Yeah, I think they'll be amazing. I think that'll be the time to get into dividend stocks, companies you love. I remember back in 2009, I bought into a Canadian, it was XTR or something, the Canadian ETF. It was paying 16% dividend. The thing doubled like over the next year. I mean, there's huge opportunity when that stuff comes to life. And that's when I think miners and equities will be great. That's when you can become a long-term investor at that stage. And once the market has reset, you can be like, okay, I'm going to buy these because I like them. I believe in them. They have a good product. You can hold them a long time. Dividends will be great. But right now it's like the opposite. Right now we're like, you're buying at maximum risk. I don't think there's much upside left. It's not worth the risk. And other than in precious metals, so there's potential there, safe potential in gold to the upside is where I see it.
Right. Interesting. And do you expand your perspective in the commodities market outside of precious metals at all? Do you look at other soft commodities or ag products and services? What about that, Chris?
Not so much. No, I mean, I'm excited for the uranium space, for uranium stocks.
Okay.
I'm big into getting a little bit bigger into climate, involved in some climate projects. And so my partner and I were keynote speakers down in London, UK in April, talking about this, trying to bring climate change education into entertainment, because everybody thinks climate is, I mean, it's a hot topic. It's either you hate it, you love it, scandals. Like, I mean, it's a very touchy thing. But long story short, uranium is kind of one of those like easy ways to generate a ton of pretty clean energy. And everybody's got these massive complex systems. You got to change so much to the grids and put new infrastructure in. It's like you could pop up these small uranium plants, like one per state. You can power like a lot of stuff very, very in a very controlled environment. And so I think that's why we're seeing uranium stocks. They've come to life over the last few years. I think people can see smart money's been shifting into it. You know, what goes out of favor and everybody thought was the most dangerous thing ever was uranium is going to come full circle and be like, oh my gosh, this is like the savior of clean tons of power. So I really like that space. And energy is huge. Obviously, we got all the EV vehicles, EV planes. Everybody is electronics for everything, right? So power is going to become the next major commodity, and uranium is access to controlling power.
Interesting. Okay. And is that, so when you say climate initiatives, uranium, obviously clean power generation, zero emissions, lots of reasons to love uranium. The public's noticed this because I feel like the biggest barrier to nuclear adoption has not been the technology or the power output. It's been public sentiment, right? Public opinion. And that's largely shifted due to re-education about, you know, the true risk and benefit of nuclear power plants and the environmental benefit and all this stuff. Anywhere outside of that, when you talk about climate that you're looking, Chris?
Yeah. So like, in climate, I'm just kind of focusing on how can we get clean energy? How can we power the world in a way that's good? Yep. And I mean, my whole focus is really just trying to help the world. You know, we got to save ourselves before it's too late. Like I believe there's serious problems at play, and the amount of energy that we're starting to draw is going to demand a lot more. And people want, you know, I think China's sparking up a lot of coal plants. I mean, there's a lot of things going on that are just so bad, right? So, the only reason I like uranium is only because I really got into the space of climate, and I have a friend who was involved with small uranium plants, and so he filled me in on it. I was like, holy crap! Like this is actually pretty amazing. And the more I learn about uranium, the more I like it. And now I think it's just a matter of, it's an asset that I like. I am not married to it, but when the timing is right, I'm going to get married to it for a while, because I just have to wait for that cycle, because I'm really excited about it.
All right. Awesome. Look, super fun having you back on the show, Chris. Technicaltraders.com. Tell my audience where they can find more of what you do.
Yeah. I mean, go to YouTube, type in The Technical Traders. You'll see my face pop up, and I share detailed daily analysis on there, and share the ETF trades that I do. Everything I do with my newsletter, what I trade, all my investments are the same things I give out to everyone else. I don't push trades out. I built the strategies managing my own money, and I share with others, and we all are a tight community. We all grow together. And YouTube or thetechnicaltraders.com.
Love it, Chris. Thanks so much for coming on today. It's great catching up with you.
Thanks, Shay. Pleasure.